In this video, we're going to be performing a deep dive on Colgate Palmolive's dividend safety. To begin, let's talk about Colgate's business model. Colgate has been in existence for over 200 years, having been founded in 1806. It operates in many consumer staples markets, including oral care, personal care, home care, and more recently, pet nutrition. These segments afford the company more than $15 billion in annual revenue. Years of sideways movement in the stock has kept a lid on the market capitalization, which is currently at $54 billion. Colgate Palmolive is a well-known dividend stock because of its compelling track record of dividend growth. With 55 years of consecutive dividend increases, Colgate Palmolive is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of dividend increases. In fact, Colgate Palmolive's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of consecutive dividend increases, Colgate is not just a dividend aristocrat but also a dividend king, an even more exclusive group of stocks with 50+ years of dividend increases. Looking ahead, investors cannot rely on Colgate's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Colgate's dividend safety in the context of the company's current earnings. When Colgate Palmolive reported fourth quarter financial results on January 25th, it announced that it generated diluted earnings per share of 70 cents in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 42 cents per share, which implies a payout ratio of 60% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Colgate Palmolive generated $2.75 in diluted earnings per share in fiscal 2018 and paid $1.68 of common share dividends during the same time period for a full-year dividend payout ratio of 61%. Using earnings, Colgate Palmolive's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Colgate Palmolive's current dividend payment to its free cash flow. In fiscal 2018, Colgate Palmolive generated $3.1 billion of cash flow from operating activities and spent $1.6 billion on common share dividends for a free cash flow dividend payout ratio of 52%. Using free cash flow, our conclusion is the same as when we use earnings to measure Colgate's dividend safety. The company's dividend appears very safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Colgate Palmolive's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Colgate's performance during this time period is shown here. Remarkably, Colgate was actually able to increase its earnings per share each year through the financial crisis of 2007 to 2009, although its earnings did experience a very minor drop in fiscal 2010. With all this in mind, we do not have any concerns about the company's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess Colgate's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. At the end of Colgate's fiscal 2018, the company had $6.4 billion of total debt and generated full-year interest expense of $143 million for a weighted average interest rate of just 2.2%. The following image shows how changes to Colgate's weighted average interest rate would impact the company's current dividend safety as measured by free cash flow. As the image shows, Colgate's weighted average interest rate would need to rise to above the 25% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Colgate's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.